Don't get overly worked up about a recession. Recessions are a natural part of life. We will have recessions and expansions. The most important thing is to have a plan and stick to the plan. I'm Ken Bauso. Some people call me Fibonacci, and let me say from the outset that this is analysis and commentary and not investment advice. When we talk about a recession, we're really talking about the business cycle. What are we supposed to look at to understand where we are in the business cycle? When I'm driving my car, I like to look through the windshield, not the rearview mirror. It's the same with the economy. Economists put economic indicators into three broad buckets: leading, coincident, and lagging indicators. Leading indicators are believed to give an indication of where the economy is going. Question for you: how would you know if a recession was starting right now? Let's consider the lead up to the big recession that started in late 2007. Recessions are officially dated by the National Bureau of Economic Research, the NBER. And let me tell you, they take their time. For the last 6 recessions, it took the NBER an average of 234 days after the start of the recession, almost 8 months, for them to tell you. I found a cool graphic in a Newsweek article. It graphs 4 points: when a recession started, when the NBER finally told you it started, when it ended, and when they told you it ended. The so-called Great Financial Crisis started in the fourth quarter of 2007. We see that it was a full year later, almost 2009, when the NBER told you that the recession started towards the end of the fourth quarter in 2007. So we can't expect any official statement from the NBER until well after the fact. If we were sitting here in October 2007, would the stock market be telling us that we're on the cusp of a big recession? Actually, the S&P 500 made a new high in October 2007. I treat the stock market with the same respect I would treat a big, dumb, and dangerous animal. I'm also deeply skeptical that the stock market is a reliable indicator of the future, even though the Conference Board considers it a leading indicator, but more on that later. So that's the stock market. How about the most popular gauge of economic activity, GDP? This was taken from the Federal Reserve's semi-annual report to Congress called the Humphrey-Hawkins testimony in February 2008, showing that the third quarter 2007 GDP was almost 5%. We were about to walk into a recession and a financial crisis, but the stock market was making new highs, and the most recent quarterly GDP was almost 5%. I probably don't need to tell you that currently the S&P is strong and the most recent GDP reports have been very good, but this doesn't tell us where we're going. So what should we be looking at? Let's look at the leading economic index. The blue line is the LEI index, the gray line is GDP, and the gray vertical sections are recessions. Unlike the stock market and GDP, in 2007, the LEI was negative. So watching the LEI in 2007 was very informative, especially because the Federal Reserve, the Treasury, Wall Street, and the financial news told you everything was fine. Looking at where we are currently, the LEI is negative and has been negative for quite a while. Note that people frequently talk about employment, but general employment is not a strong leading indicator. Typically, businesses do everything they can to hold on to people and only start cutting after the economy turns down. There's a good indicator in the LEI that measures hours worked, which makes sense because businesses generally cut hours before they cut people. These are the components of the LEI. I spent years working with this data, and I can tell you that this whole index can be pretty well approximated by just using the yield curve. And I've made a previous recording about why it's so important. Our economy is credit-based, and we need continuous expansion of credit to maintain a healthy economy. When the yield curve is inverted, the banking system doesn't have a strong incentive to expand aggregate credit. And to make a tangential point regarding interest rates, there is a significantly strong relationship between the health of the housing market and the economic cycle. And we know that with mortgage rates almost doubling, the real estate market is not exactly robust right now. Basically, I'm saying the business cycle still exists and interest rates still matter. Some of the components of the LEI give a stronger indication than others, which is beyond the scope of this recording, but in theory, the stock market should be a forward-looking indicator. But based on the data and based on my direct experience, sometimes it behaves this way and sometimes it doesn't. Who do you expect to tell you this information? Wall Street is in the business of selling securities. They're very, very rarely broadly negative on the economy. I don't think the Federal Reserve has ever forecasted a recession, maybe during COVID, and I would argue that they don't want to. I think the Fed views itself as having an economic leadership role, and perhaps if Powell came out and predicted a recession, everyone would get scared and save more, spend less, and make a recession more likely. The Fed doesn't want to do that. How about the Treasury Secretary? She works for the president, and so all you're going to get from that office is how great everything is. So it's unlikely you're ever going to hear forecasted bad news from Wall Street, the Federal Reserve, or the Treasury, and let's not even talk about CNBC. There are various levels of uncertainty here to point out. Even though the LEI index has previously been an excellent recession predictor, and I think it would be foolish to disregard it, we don't know with certainty that it will be again, and we've got to be honest about that. Also, even if we knew with certainty that we'll have a recession soon, we don't know what that means for the stock market. It's been true that bad things have been more likely to happen in the stock market during a recession, but this is also an uncertainty. In the tech bust recession from 2000 to 2002, where the S&P went down 60% and the NASDAQ went down 80%, not only did so-called value stocks not go down, they went up. So as I said before, have a plan and stick to the plan. I think it's foolish to disregard this data, but I wouldn't use this to make a binary decision of being all in or all out. I still have stock market exposure, but personally, I don't think this is the time to swing for the fences in the stock market. This is not investment advice. Also, there's a curveball I want to contemplate. Recession discussions are typically argued with reference to domestic economic indicators, as I've been just discussing with you. But we must consider what else is going on with the world. The Federal Reserve rarely talks about non-US circumstances as a significant driver of US policy, but at times it is. For example, Janet Yellen is the current Treasury Secretary, and in 2015, she was Fed chair. And in 2015, it was her view that because unemployment was so low, that must mean inflation was right around the corner, a relationship posited by a model called the Phillips curve. Even though the Phillips curve has been sufficiently discredited, in my opinion, Yellen and her vice chair, Stan Fisher, were hell-bent on using it, even though inflation was well below target. They guided the financial markets that they would soon begin raising interest rates, and their guidance had the effect of driving up the price of the dollar. This should have been an indication to her that she was doing the wrong thing. Think about what a strong dollar does to inflation rates. The price of everything we import goes down. That's deflationary. The price of everything we produce here in the US and sell abroad goes up. That's also deflationary because all else equal, customers will buy less when the price goes up. Yellen seemingly disregarded the domestic and international impact of a strong dollar until China, who manages their currency, the yuan, with reference to the dollar, finally couldn't take it anymore because dollar strength for us also meant Chinese yuan strength if they were going to keep their quasi-peg. But the Chinese economy couldn't take it. China started devaluing their currency, their financial markets were a mess, and Yellen was forced to back off of her plans to increase interest rates. So why am I telling you this? Here's a graph of the current inflation rates of the major economies. Most of the world is transitioning out of inflation-fighting mode. Many large economies around the world are flirting with recession or are in one already, and a global central bank easing cycle has begun. Germany is one of the largest exporters in the world, and they are likely in a recession. The European Central Bank is starting a rate-cutting cycle. The Swiss Central Bank started cutting rates ahead of the ECB because if they don't, the Swiss franc will get too strong. China's economy is very weak. They need to stimulate their economy, but their hands are tied if they don't let their currency float freely, which they don't want to do. If the Federal Reserve is among the last to start cutting interest rates here at home, it's going to drive up the value of the dollar, and in doing so, it will exacerbate the problem that China is having domestically. Of course, when the Federal Reserve is asked about these international pressures, they always say, we manage our interest rates for our own economy, but of course, sometimes that isn't true. So where am I going with this? Central bankers are in constant contact. If China is in very bad shape, which is not exactly known since the Chinese system is so opaque, then I think it's possible they could pressure the Federal Reserve to have lower rates than they would otherwise, since a crisis in the second largest economy in the world, China, would have negative implications for our own economy. To the extent these actions would be helpful to keep China out of having a big problem, the policy easing here at home could also help mitigate some of the economic indicators I discussed earlier and possibly keep us out of a recession. So I'm suggesting that it could be an upside surprise for us here in the US, but we'll have to see the specific circumstances. At this particular point in time, I'm watching international developments very closely. Currently, the Fed is guiding towards 3 rate cuts this year, probably starting in June. I see credible people arguing that the Fed shouldn't be talking about cutting rates because the economy is doing fine and inflation is not yet back to target. Even if you disregard the recession risk evidenced by the leading economic indicators that I just highlighted, in my next recording, I'm going to tell you why rate cuts make sense this year and people critical of that policy are wrong. As I said before, the best thing is to have a plan and stick to it. This is commentary and analysis and not investment advice. Thanks for listening.